How are things now? My name is Paddy, and welcome to the seventh episode of my podcast, Finding Cashflow. On this episode, I'd like to focus on the population growth in Canada throughout time. Population growth is something that has come up many times in previous episodes, especially when we're talking about demand for rental housing in our country. But population growth is a very important topic in economics because it is very well agreed upon by economists that substantial increases in population growth has substantial effects on a country's GDP. And now is a very pertinent time to be talking about population growth in Canada because we have just come through the largest swings we've ever seen across the history of our country in population growth over the last few years. And we've just seen the largest swings I think we're likely to see for years and maybe decades into the future. Because in 22, 23 and 24, we had 3 years of back-to-back record population growth. In 2022, we added 1 million people to Canada for the very first time in a yearly period. This was a percentage increase of 2.7%. In 2023, we added even more people to our country, over 1.2 million people in that year. And this was a percentage increase of 3.2%. This was just off our all-time record high for percentage increase in population growth, which we saw in 1957. This was at the tail end of the post-World War II baby boom, and we grew our population by 3.3% in that year, which equated to about 500,000 people being added to the country. And in 2024, even though population growth had decreased quite substantially, that was still another record year for population growth, a year in which we added over 750,000 people to Canada. But now that has all changed very substantially, and now we have almost completely stagnant population growth. And this is in keeping with the government's plans to reduce the amount of non-PR residents in our country from 7% down to around 5%. And they announced these plans in April of last year, about a year and a half ago now. And this may seem like a reasonably small change, but essentially what this results in is zero population growth for the entirety of this year and for next year. And this is something that this country hasn't experienced before, even going back to the Great Depression, where immigration collapsed for a number of years. The high birth rates in Canada at that time ensured that population growth continued to remain in positive territory. And even during the World Wars, where there was heavy overseas casualties, the population of Canada was still growing at that time, once again because of a high birth rate. In the oil shock of the 1970s, as well as the recessions of the 1980s, the 1990s, and the Great Recession of 2008, the population of Canada still remained in positive territory. And even during the COVID-19 pandemic, where the borders were shut and immigration essentially went to zero for a period of time, and then with a lag effect, we saw the birth rates come off. Birth rates came off around 9+ months after the onset of the pandemic. But even in any of those years, we still didn't experience zero population growth in our country. But in Q1 of this year, the population of Canada grew by just 20,000 people, which essentially is 0.00% population growth. And once again, this is something that our country has just never seen before. So now I'd like to go back and look at how population growth ties in with economics. And population growth always has a substantial impact on the GDP of a country. GDP can be looked at from a productivity point of view or from a consumption point of view. But first, looking at GDP from a productivity point of view, the GDP is all of the goods and services that a country produces in a year. It is the output per worker, which is the productivity, multiplied by the amount of workers. So the more workers we have, the larger the GDP will be. But when people come to a country first, before they become a worker, before they add to the productivity of that country, they're immediately adding to consumption. When people come to a country, they have an immediate need for services and goods such as housing and food and transportation and healthcare. And eventually this will lead into more people entering the labour force as well, but immediately they become a consumer within a country. For anybody who has immigrated to a country before, something I've done on more than one occasion, you'll know that you spend a lot more money over the first few months and perhaps for the first year than you earn. Before you become a worker, you have an immediate need for housing. You have an immediate need for food. So adding lots of people to a country has an immediate impact on that country's GDP. We've seen this before in North America in the past World War II baby boom, where the population of Canada and the US grew substantially. This went hand in hand with years and decades of strong GDP growth. And we saw the opposite in Japan from the early 1990s until present day, where Japan has had a stagnant or declining population growth, and this has coincided with stagnant GDP growth. So now is a very important time to talk about the swings in population growth in Canada, because I believe these will have a very substantial impact on the GDP of our country. Because Canada has been in a GDP per capita recession now for the vast majority of the last 3 years. And this has been due to poor productivity growth in our country. But because we were adding the amount of workers or the amount of people producing to our country substantially, that is what has kept our overall GDP in positive territory. So why the sudden shift in government policy? Well, essentially all this is stemmed from a housing crisis. Because for anybody who looked at the second episode of this podcast, which is called The Supply Side, in that episode, we looked into great detail into the supply of new homes in our country going back to the mid-1950s. You'll know that we would have been doing very well in any given year to add 250,000 homes to our housing stock. In fact, from any year from the mid-1950s up until 2022, with 2022 being the last year that StatsCan has data for new home completions in our country, in all of those years, it was only 2 years in which we added more than 250,000 homes to our country. Those years were 1974 and 1977. Now, the conclusion of that episode is I believe we're going to smash that record this year, and we will break that record from the 70s again next year. But irregardless, we would be doing very well to add 250,000 homes to our country in any given year. Having said that, we added 4 times that number. We added 1 million people to our country in 2022, and we added 5 times that, 1.25 million people to our country in 2023. So it is very easy to see where this housing crisis came out of. However, the average asking rental prices has now peaked almost 2 years ago and has been declining fairly substantially since then. Even cities like Calgary are now seeing fairly substantial decreases in their year-on-year rental rates. But it was because of this housing crisis that the government completely changed their stance on immigration inflows and therefore on overall population growth. So let's now look at the various demographics of population growth. And we'll look at the natural increases, which is the births minus deaths. We'll look at international migration, and immigrants are people who are come to the country as permanent residents. And we'll look at non-permanent resident inflows, which is international students, temporary foreign workers, as well as refugees and asylum seekers. So the first graph here, we're looking at what we call the natural increase through our population growth. And the natural increase is the birth rate minus the death rate. So in this graph here, we have the birth rate in green at the top of the graph. We have the death rate in red in the middle of the graph. And then the difference between the two is the blue line. Now, if we look at the birth rate, which is the green line, it has remained range-bound between around 350,000 to 400,000 going back to the early 1970s. Now, this may look like a stable birth rate, but in actual fact, the birth rate in our country has been falling off dramatically over the last few decades. The birth rate is the amount of births per 1,000 people, and this has almost halved throughout this time period. However, due to the fact that our population has doubled, the amount of births that we have each year is remaining quite stable. And then if we look at the death rate in red, the death rate has essentially doubled since the early 1970s, and this has doubled in line with the doubling of our population. So with a fairly stagnant amount of births each year, and with a death rate that has doubled over the last 4 decades, this has resulted in the difference between the two heading towards zero. And it is easy to foresee that in the coming years, in the not too distant future, we will get to a stage where the death rate, because it is inevitable that that will keep on increasing, is very likely to outpace the amount of births that we have in our country each year, meaning that from natural causes, births minus deaths, we'll actually have a decrease in the population of our country due to there being more deaths in any given year than the amount of births that we have in that same year. On a side note, to tie in the birth rate with economics, we can see that the amount of births increased in the late 1980s. This is when we had a period of relatively low interest rates and strong economic growth. But then after the recession of the early 1990s, which was the last substantial recession that Canada experienced, and certainly the last substantial housing recession that our country experienced, we saw that the birth rate dropped off fairly substantially. And then it once again increased with the relatively low interest rates of the mid-2000s, but once again peaked after the Great Recession in 2008, and we've also saw a decline due to the onset of the COVID-19 pandemic. Here in the second graph, we can see net immigration to Canada. Immigrants are people who come to our country who already have permanent resident status. And we can see that the amount of immigrants coming to Canada increased substantially from the mid-1980s right up until 2020. We then saw a drop-off in immigration due to the COVID-19 pandemic. But then after the pandemic, immigration surged, almost doubling in that time period. Then in the red line, we've immigration with an E. Immigration with an E are permanent residents or citizens of Canada who are leaving the country, and the red line is the net immigration, the permanent residents and citizens leaving minus those who are returning. And then once again, the blue line is the difference between the two. It is the difference between the people migrating to Canada minus the people who are migrating from Canada to other countries. And because inward immigration has surged in recent years, while outward immigration has essentially remained stagnant, the difference between the two, the blue line, has once again seen a substantial increase from 2021 onwards. And 2022 was the year in which immigration peaked in our country, at almost 500,000 people. And I would like you to take note of the scale of this chart, because where we saw a peak in immigration at 500,000 people, the peak in non-permanent residents far surpassed 500,000 people. Non-permanent residents are international students, temporary foreign workers, as well as asylum seekers. We saw a substantial increase in this number in the late 1980s. Once again, this was a period of relatively low interest rates coming out of the very high interest rates of the late 1970s and the early 1980s, and this was a time of strong economic growth. But once again, this dropped off substantially following the recession of the early 1990s. And once again, we saw the amount of non-permanent residents coming to our country start to increase again after 2015. But the real surge in non-permanent residents coming to Canada was once again post-pandemic. And this number absolutely exploded in 2023 and 2024. In this graph, we're looking at the changes to our population through natural causes, which is births minus deaths, which is the green line, through immigration and permanent residents being added to our country in the red line, and then the non-permanent residents in the blue line. And if we were to add all these up, we can see the total impact it has on our overall population growth. And where our population growth remained in the range of 250,000 to 400,000 people for the vast majority of the last 4 decades, we've seen it surge, especially in the years of 2022, 2023, and 2024. But once again, this has now dramatically changed, and we're due to have zero population growth for this year and for next. And I'd like to again point out that these large increases in our population over the last few years inevitably led to an increase in our country's GDP, because having more consumers in our country led to an increase in demand for goods and services in our country. But now, with population growth having stagnated, we can no longer look to population growth as a source of growth in demand for goods and services in our country. And I'd like us to ask ourselves a question that we asked ourselves in the last episode of this podcast, and ask ourselves, what effect will this have on the rental market? Because I know we've just come out through a housing crisis, but again, that coincided with years of record population growth in this country. But now we have no newcomers coming to this country, and this is coinciding with record years of supply, including record years of completions of purposeful rentals. Now, I know CMHC has determined that we need to build 500,000 homes each year for the next 7 years to bring back affordability. And perhaps in a separate podcast, I can go into how they got to those numbers. But the one thing I'd still like to say about that number of 500,000 homes for now is that it's impossible. I just said earlier on in this episode that in any given year between the mid-1950s and 2022, there was only 2 years in which we were able to build more than 250,000 homes. And that was in 1974 and in 1977. Now, the conclusion from that episode, and this is something that I still haven't heard from other people in the industry, but I predict that we're going to break 250,000 homes and break that previous record, perhaps not just in this year, but in next year also. But still, having said that, I still think we're going to be shy of completing 300,000 homes either this year or next. The reason I think we'll have record years of completions this year and next year is because we had record years of building starts in 21 and 22, when interest rates were at all-time lows and there was just an insatiable demand for new homes, and these presentation centres were completely packed at that time. And because of this boom in construction, the industry had a dire labour shortage at that time. And this was at a time that we had a record amount of people coming to our country, many of whom were working and looking for jobs in the construction industry. And the industry was barely able to keep up with all of the products that it needed to construct all these homes. And given all that stress on the construction industry, we still will not likely be able to complete 300,000 homes either this year or next. So how the CMHC thinks we'll be able to build 500,000 homes each year for 7 years in a row is just simply not realistic. So now I'd like to move away from those CMHC numbers and back to reality. And our current reality is that despite the fact that we've had massive population growth, anybody who has come to this country over the last few years is now already in this country and they're already living somewhere. So who is going to fill up all these new homes that we'll be completing? Now, I know people will say that there are accommodations out there which are still very much overcrowded, and there might be people in those accommodations looking to get their own accommodation. As well as that, we have young adults who are currently living with their parents that may be looking for new accommodation. But at what scale will that be happening now that we have very high levels of youth unemployment and a very high level of overall unemployment, which is still trending upwards? And even if these people were to look for their own accommodation at large scale, can they possibly offset the, on average, 1 million people who have been coming to our country over the last years? Because it was those people that were putting real pressure on our housing stock at that time. Now, I know people will say that because of our unemployment situation, that we need to now reduce immigration to keep the jobs that we are creating in Canada, which isn't very much jobs over the last few months, that we need to keep these jobs for people that are already in the country. And I'm certainly not going to argue with the people that say that, but I would ask them to remember that in the year of record population growth in 2023, in the summer of 23, our country had 1 million job vacancies. Employers were screaming out for people to come work for them at that time, and there was absolutely no complaints regarding high immigration at that time. I'd also like people to remember that any of these immigrants who have come to the country over the last few years, these people came here as legally as anybody has immigrated to this country over the last 150 years. And I'd also like people to remember that it is these recent immigrants that will end up being the biggest victims of our government's reckless immigration policy. It is now almost impossible for these non-permanent residents to get their PR. It will be impossible for them to stay in the country, and a lot of them end up going back home. And this is after spending all their life savings to come to Canada in the first place. And these people did that to come to Canada to live in this beautiful country and realise the Canadian dream, which is no different to what the majority of us and or our ancestors have done in recent times. But for the purpose of this podcast, I'm going to focus on how immigration and population growth overall can impact our economy, because it's almost impossible to get people to agree on economics, and I'm certainly not going to try and get people to agree on immigration policy. And on the point of view of getting back focused on the economy, I'd like to now switch focus on what I think is the most important things that are happening in our global macro economy, and that is the level of debt as well as the level of bond yields in the G7 nations. So, firstly, we have the UK 30-year bond yield, or the 30-year gilt yield as it's called in the UK. This is the interest rate which the UK government pays when borrowing money for a period of 30 years. And this 30-year gilt yield is at its highest level so far this century, at its highest levels dating back to 1998. And the UK 10-year gilt yield is at its highest levels dating back to early 2008. In the red circle is Liz Truss's mini budget in September of 2022. This is when Liz Truss and the Chancellor of the Exchequer, Kwasi Kwarteng, announced £45 billion in unfunded tax cuts in their fall budget. This led to investors losing confidence in the ability of the UK government to run prudent fiscal policy, and yields surged as a result. And it is very important to understand why yields surged because of this, and we will go through this in the next episode when we look into the G7 government debt and their rising bond yields. I also want to highlight October of 2023 in this chart. This is when US Treasury yields peaked. And I will highlight October of 2023 in each of the following charts, as I want to highlight how all global bond markets are dependent on US Treasury yields. Finally, I'd like to note how rates are higher now than they were at the end of the Liz Truss mini-budget saga, as well as in October of 2023. Next is the France 30-year bond yield, and France's debt servicing costs have been rising due to their fiscal situation. The French government has a deficit of 5.8% compared to their GDP last year, and this is far surpassing the EU limit of 3%. So the French government will need to cut spending or raise taxes, or both. But the French people are having none of this, and they are completely unwilling to accept austerity, and we have seen many riots break out in the streets of France in recent weeks because of this. So the French government are now in a very difficult situation as they attempt to reduce their government deficits. And investors, who are becoming increasingly worried that France will not be able to repay its debts, are now pricing in a risk premium into the bond yield. We analyse how risk premiums work in episode 5 of this podcast, and we'll go over this again in greater detail in the next episode. Once again, we can see the spike in French bond yields in October of 2023, coinciding with the peak in the US Treasury yields at that time. Next, we have the 30-year German bond yield, or the Bund yield as the Germans call it. The German fiscal situation is better than that of the French, and the government of Germany have a deficit of 2.7%, which is below the EU target of 3%. But the German economy is showing signs of stagnation. Stagnation is where you have stagnant GDP growth plus inflation. As we looked at in episode 5 of this podcast, higher inflation expectations drive up bond yields. We looked at this in episode 5, where we looked at how the money that Amara owes us in interest each year, as well as the principal which she will pay us back at the end of the term, will be worth far less by the time that she will be paying it back to us due to inflation. And once again, we can see the peak in the German bond yields in October of 2023. However, borrowing costs has since surpassed those levels in Germany also. Next, we will look at JGBs, which are Japanese government bonds, and here is the Japanese 30-year bond yield. JGBs have quickly shifted from a period of ultra-low interest rates to much higher rates in relative terms. This is due to the Japanese central bank moving away from yield curve control and due to higher inflation expectations overall. These rising yields put pressure on the yen carry trade. This is where investors borrow yen at low rates to invest abroad and make higher rates of return, in US Treasuries as an example. Higher JGB yields also results in a stronger yen, which puts further pressure on the yen carry trade. And this is a very important phenomenon in our global economy, and we will go through this in a lot more detail in a separate episode. Once again, we can see the peak in rates in October of 2023, but borrowing costs in Japan, especially at the 30-year level, have almost doubled since then. And finally, we will look at what is the most important market in our entire global financial system, which is the US Treasury market. And here, we are looking at the US government's borrowing costs when borrowing money for a period of 30 years. And it was in October of 2023, like we've mentioned many times already in this episode, where Treasury yields peaked, dragging bond yields all over the world up as a result. Now, I have to admit that I did believe that US Treasury yields would have gone higher from here, and I have so far been wrong about this. And this is because that US Treasuries are still seen as one of the world's most safe haven assets, due to the fact that the US has the world's reserve currency, and because of this it can print money, as well as having the world's largest and strongest military. But the US government has debt servicing problems of their own. Last year they spent $6.75 trillion, and they are spending even more this year than they did last year, and this is in spite of the efforts of Doge at the beginning of the year. Because the vast majority of their expenditure is extremely hard to cut. Items such as Social Security, Medicare, defence, even the interest that they now owe on their debt is becoming one of their largest expense items. The revenue that they raised last year was $4.92 trillion, and this leads to a deficit of $1.83 trillion. So, with a total debt of $37.54 trillion and a total US GDP of $29.18 trillion, this leads to a debt to GDP ratio of 128%. But it isn't the size of the debt that is necessarily the issue, it is one's ability to service that debt. And with a deficit to GDP ratio of 6.3%, and with 12 trillion of debt that needs to be issued or sold by the US government next year, some of the best and most brilliant economic minds of our time, people such as Ray Dalio, are becoming very worried about the US's ability to service its ballooning debt. This is what Ray Dalio would refer to as the end of the long-term debt cycle. But even if we aren't at the end of the long-term debt cycle, I'm becoming very sure that we are nearing the end of a short-term debt cycle. The start of the end of the short-term debt cycle is marked by a substantial increase in interest rates. And as can be seen from this chart, which we've looked at in many episodes before, where we're looking at the overnight rate of the most important central bank in the world, the US Federal Reserve, the short-term debt cycle typically doesn't end until rates have already peaked and started to come back down again. And we saw that the Fed started cutting rates again last month. And what marks the very end of a short-term debt cycle is typically a recession. And once again, why the recession commonly happens after rates have peaked and come back down again is because the continual refinancing that our economy is going through results in borrowing costs continuing to go up even after rates have peaked and started to come back down again. And this is certainly the case for US government, as the vast majority of treasuries that are maturing were issued at lower rates than the rates that they'll need to be reissued at, meaning that the debt servicing costs of the US government is still going up even though rates have come down. This is also true for the vast majority of Canadian households. I was listening to Ron Butler and Steve Suretsy in a podcast last night. These gentlemen are two of the most listened to voices on social media as well as Canadian national television regarding Canadian real estate. And towards the end of the episode, Steve said that we are past the mortgage renewal cliff, and he, as well as many other prominent real estate podcasters, have mentioned this many times. But this is completely incorrect, and I will prove this to be incorrect using math in a separate episode. Here we can see a chart from the Bank of Canada's 2024 Financial Stability Report, which shows that it is only the variable rate mortgages with variable payments that have already seen their peak increases in mortgage refinancing payments. And these mortgages only made up less than 6% of all outstanding mortgages, as can be seen from this report by the Bank of Canada in 2022. Over 70% of the outstanding mortgages were a fixed rate mortgage, and almost 23% of mortgages were a variable rate mortgage with fixed payments. These types of mortgages were 4 times more popular than the variable rate mortgages with variable payments, and it was these mortgages that went into negative amortization over the last few years. And it will be these mortgages that will experience the largest increase in payments, as can be seen by the green bar in this chart. We will go through all this in even greater detail in another episode. And it is because of this phenomenon in the constant refinancing of our overall economy that is why recessions almost always occur after rates have peaked and have come back down again. And as mentioned already, it is a recession that marks the end of the short-term debt cycle. I would strongly suggest to everyone to study carefully this video from Ray Dalio on the short-term debt cycle and how our economic system works. Ray Dalio attributes this knowledge to what has allowed him to sidestep previous recessions and states that it is this knowledge that has enabled him to become a self-made billionaire, the founder and CEO of one of the world's largest hedge funds, as well as one of the best economic minds of our time. And Ray now seems to be at the very end of his career and seems to be past the point of being motivated to make more money, and genuinely seems interested in passing off the knowledge that he has to us through these videos on YouTube, as well as a few great books that I'll recommend to you at another time. So where might we be seeing the evidence in financial markets that we may be coming to the end of a short-term debt cycle? Well, one of the places where I believe this evidence is showing up is in the gold markets. Gold is up 44.5% in the past 12 months. This is an achievement that the S&P 500 hasn't achieved on a yearly basis going back to the mid-1950s. In fact, the S&P 500 has only ever achieved this type of growth twice before, in 1933 and in 1954. And both of those times were where the market was recovering from a deep recession. The best year for the S&P 500 during a bull market was in 1928, at the peak of the Roaring Twenties, when it gained 37.9%, quite a lot less than what gold has experienced in the last 12 months in US dollar terms. And gold has more than doubled in the last 2 years alone. This is a feat that has taken the S&P 500 5 years to achieve. Yet it is the S&P 500 that is widely spoken about and gets all of the news coverage. But it is only in recent weeks that gold is now starting to appear in the news as well. It seems as though gold needed to double in value in a 2-year period to get the attention of the media. And where the S&P 500 has gone up 461% in the last 20 years, gold has gone up by over 719% in that same time period. So that was a lot of data regarding our global economy, and unfortunately a lot of the data doesn't seem to be very positive regarding the outlook for our global macroeconomic situation. But I'm not trying to put any positive or negative spin on this data. I'm simply trying to look at the data that I honestly believe that we look back on a few years from now as the data that we really should have been focusing on. So for everybody who has followed my content from the start, for everybody who has looked at these last 7 episodes that embarrassingly has taken me more than 7 months to put together, I want to thank you very much for your support, and thank you very much for taking the time to look at these episodes. And I hope to see you all again soon, hopefully.